And welcome everyone to today's webinar hosted by Quantifi, a provider of risk, analytics and trading solutions for the global capital markets. My name is Sakbir Chima, Director of Marketing at Quantifi, and I'll be your host for the webinar. This Quantifi webinar with guest speakers from BlackRock and OTC Partners will explore the key drivers of liquidity, the various methods adopted by buy-side firms for managing liquidity risk, and the importance of modern technology in helping firms manage liquidity risk more efficiently and effectively. I would now like to introduce today's speakers. We have Rahul Patel, Senior Business Consultant at Quantifi, who has over 10 years experience working with buy and sell side firms. We have Russo, Director of Risk Management at BlackRock, responsible for investment risk strategies across EMEA, and Steinberg, who's founder of OTC Partners, a boutique consulting firm focusing on market structure, risk, and regulatory matters. At the end of the webinar, you will have the opportunity to pose questions using the panel to the right of your screen. If we do not have time to answer all your questions, we will respond to your questions by email. Once the webinar is complete, you will present us with a short survey on liquidity risk, and we would appreciate you taking a couple of minutes to complete this survey. Findings from the survey will be emailed to all those that participate. I will now pass you on to Steinberg, who will talk you through the key drivers of liquidity. Thank you, Sol.
Sakbir, thank you so much, and greetings to the entire audience. I hope everyone is having a wonderful day. So when we talk about liquidity and liquidity in the marketplace, there are really a few overhanging factors that affect today's liquidity landscape. So those factors at a high level are what's happening in the regulatory environment in a few different ways, the digitalization of markets, better technology, connectivity, and connected systems, and what that is doing to how we approach the markets, how we trade, and how we view liquidity and liquidity depth, and where we route our trades. And also, there are other new players in the market, new entities, new utilities, but buy-side participants that are taking on more of a market maker type role. We're also seeing the advent of new security types. So formerly exposures that we can only capture in the OTC markets are now becoming much more liquid and really usable market for the buy side. So the exchange traded has seen some significant growth, and we're going to go through that as well. And we also need to note when we look at exchange traded that the OTC market has remained extremely robust, extremely large, and we'll look at growth rates, but we've had still the liquidity sources in the marketplace today. We're going to look at that as well. So if we schedule for a number of key initiatives like Basel III, like non-cleared margins, and other key regulatory timelines. Last several years, we've implemented several different rule sets between Volcker, Dodd-Frank, EMIR, MiFID, Basel III. These implementations have been ongoing in the last several years, and they've really consumed our day-to-day. And we've, as an industry, been happily to comply, to set up new and to enact these new regulatory rule sets. And this is ongoing today. So we have these teams of people at various banks and buy sides and other market participants continuing to enact the regulation that you see. And what has most affected us has been the non-cleared margin rules and MiFID II reporting. So those are real red hot right now. We are doing all of this in a backdrop of extreme regulatory uncertainty. Now, you can say to yourself, how can we have so much uncertainty when we have all these timelines and clearly being implemented? Well, it's really the environment that we're in today. If we look at our North American Western environment, we see that Donald Trump rule sets that we are currently implementing or have already implemented. So potentially the rescinding of the Volcker Rule or rescinding parts of Dodd-Frank, and this is causing a lackluster drive towards growth of setting up systems, processes, and procedures towards these rule sets. There is an element of people moment. If we look towards Europe, we see that post-Brexit fragmentation has caused massive disturbance in the regulatory regime. People are in a similar way seeing what happens. Other aggressive participants are even using this time as potential regulatory. Global OTC markets, we can see that the notional principal, gross market value, and gross credit exposure has been flat to down for the last several years. Now, some of this could be due to compression as far as the notional volume shrinking. However, the decrease of gross market value and the very slight increase of gross credit exposure, very slow growth rate in these trends. We're moderate growth environment across currency, maturities, and we do see some growth in other financial instruments as far as by sector of counterparty. So across the markets, we're not seeing a tremendous amount of growth. Now, this is very odd because we have better technology, better connectivity, better price discovery in the marketplace as well. So through the use of new market utilities like SDRs and the MiFID II transparency reporting regimes, as well as the increased presence and effectiveness of algorithmic trading and high-frequency traders, which have dominated the marketplace in the last 80 to 90% of all trading. We have the development and the advent of total cost analysis, TCA. So we're getting a lot more insight onto how we're made present. However, we're still not seeing the growth. So why is that? Let's dig a little bit deeper at this. What we see is we're seeing increase in cost analysis players tend to prefer exchange-traded products because they're more easy to synthesize, more easy to digitize, and we can have more data points on those products. But we see the growth rate of those products is quite good. However, the market share and the notional volumes compared to the OTC suite today, we see increased liquidity, seeing some slower adopters to use these products compared to the products that they've used in the past. We see paints an interesting picture in rate products in the marketplace, but we're not seeing that as strongly in the foreign exchange partners or the foreign exchange users. So rates, OTC rates continue to be extremely liquid, where other products have suffered more in these last two years or so, and really the last 1 year specifically, we've seen the most significant. Our CCPs continue to be similar players, as well as TradeWeb dominating the CEF market share space. So these are the main liquidity sources, the main liquidity venues, and the most commonly chose liquidity routes and execution routes and settlement routes. We've seen a decreasing number of FCMs throughout the line. We continue to see more consolidation throughout that space, also affecting liquidity. Place. Revisiting CEF market share, this is really one of the most important factors when we're talking about global liquidity and the stability of liquidity in certain venues. So more than anybody else, Bloomberg and TradeWeb have been the source for global market liquidity, and we've seen this trend remain very strong. So with that, back to Sashvir.
For BlackRock,
one may react to the changing liquidity landscape. And what I aim to show is the way in which liquidity assessment, liquidity risk management is being integrated in a much more deliberate fashion in a day-to-day risk governance and risk management framework. Now, there are a number of ways of assessing liquidity and managing liquidity, and I want to concentrate, broadly speaking, on 3 of them. The first is through the adoption of liquidity tiers. The other one is through the calculation, the estimation of expected transaction costs, and the third one is through the estimation of capacity, market capacity, so the days it may take for a position to be turned from what it is into cash. First of all, brutal approach, but has advantages, is they represent a taxonomy to assess portfolio liquidity in a mostly qualitative fashion by grouping securities into different markets are rated from the most. In this particular case, we are showing examples of 5 liquidity tiers. An important consideration, which is at the same time incorporate the size of any position one may hold and cost of redemptions. So redemptions can be options. There are various ways of forecasting redemptions, and at the end of the day, the redemption forecast models are based on trying to estimate, trying to model the expected behavior of investors. One may take into consideration a spectrum at whose ends there are, on one side, those investment strategies where investors are very easily identifiable. Obviously, in some cases, you know how they may, and this allows a fairly clear identification. So it's common in these cases to group investors by type, institutional, endowments, private wealth management, and so on. And each of these types is expected to complement about concentration by the top investors, how long each investor has been in a fund, what type of experience of the strategy has been felt by each investor, and so on. Those are very widely distributed strategies where investors are not, even in their case, more on real forex macroeconomic factors, expectations, even new parameters are estimated on a daily basis through estimation universes, and we are then backtesting them to check whether we are doing a very good job of estimating expected redemptions. The way we can use them is, one can use them by using the liquidity target, the expected normal time redemption, and see that this remains above a certain target. And this means that an investment management can actually react to deterioration in liquidity profile without this deterioration actually having to happen in real life. On the other side, one can estimate the possibility of liquidity shocks happening by taking the market value allocated to those tiers, which are at the lower end of the liquidity spectrum, and expressing them as a percentage of whatever NAV would be remaining following a tail estimated redemption. And this an extreme redemption, and again allows an investment manager to to start acting before, and allows for a much more deliberate. The other assumed one component indicates the impact due to market, and the impact on the cost function of market capacity. So the bigger a certain trade, the more likely the price of a certain asset is to be shifted away from initiated. And these two components can be put together to estimate the cost to transact certain assets. Incorporate market state variables whereby these models are constant. They are independent of the size of the transaction and market impact. And today I wanted to do nothing other than giving some examples of how market capacity could be estimated. So if we go through what market capacity is, in its simplest form, market capacity often is approximated to the average daily trading volume, and that's an easy way of thinking of the way market, how much the market may digest of a certain asset. But this is something which is indicative only in a limited array of cases. And there are a lot of asset-specific considerations which has to be carried out, availability of data, cross-asset effects, and so on. So some examples are these. So this is the opening, and we can see that within less than an hour of opening, the top ETFs have traded 8 times, 3 times, 2.5 times what had been traded on average in the previous 20 business days. Now, this is something which should be taken into consideration with any instrument which is defined in reference to, for instance, an index of other assets, and the liquidity of and what it is actually traded in the underlying basket. There are cases where some predictable patterns exist in the market, and this can be taken into consideration to estimate market capacity. This is an example of the impact of major equity index rebalances. The big peaks are the dates in which rebalance that on the dates of rebalances, market activity is not really it is not really a good reflection of what was being traded, advertised. Reasons why on the fixed income aging to come out in market capacity, regulatory reasons as well. We have been going through a very prolonged period of very low rates, which has actually has changed investors' behavior. Regulations have caused a change in the behavior of broker-dealers, whereby the ability of managing and inventory has been reduced, and this has an impact on the tradable volume of fixed income securities. Availability or reliability of trading data is very patchy in the markets. Primary issuance has remained really strong, and this combined with the reduction of secondary market volume means that the issuance to be made on fixed income securities, it seems as if empirically the rating may have an influence on market. It may be because highly rated securities seems to influence expected liquidity. The bigger an issue, the more liquid it seems to be, and actually the age of bond issues also seems less liquid it seems to be. All of these characters should be integrated in any model which appears to, which aims to calculate, to estimate market capacity. And this is another interesting consideration if one is fortunate enough between the trade volume which is being sent into the market and the volume which has been actually traded into the market. Usually this difference is totally academic, whatever is sent is traded, but there are situations where there is actually a disparity between the order sent, and usually these are situations which herald market stresses, and I made a consideration about a state variable. This is something which could be used the model from. This is another indicator which should be used. Now, going to integrated management and product management as well. This is an index, is an equity index, but fairly not very liquid, and this was a major rebalance, and one can think that the accumulated ex ante relative risk between a portfolio and the index it tracks. So rebalancing an index at once in a day, on the day of rebalancing the portfolio on the same day, probably be very expensive in terms of market impact, but it will minimize the active trading rebalance over 3, 5, 10 days. Then the market impact is most likely going to be much lower, but the portfolio will diverge from the index for, I don't know, and aggregated in which to rebalance an index. To rebalance an index with liquidity considerations, these are examples of 3 strategies which suffer from the impact of increasing and defined in reference to a certain time, alongside the change in value of the strategies given due to market stresses. One can also estimate the impact due to transaction costs, and actually how much value be available to investors over which time horizon, rather than simply showing that we'll suffer a loss due to my stress test, is a financial crisis stress test, but only 21% of the initial allocation into the fund. So it actually, I'd leave it at this. I hope this has been very quick, but I wanted to give an indication of what the way a buy-side sector is reacting to changes in liquidity conditions in the market. And I listed actually a few bits which could be achieved through Google if one wants to carry out further research. And I think I now pass it back to my hosts.
Great, thank you, Antonello, for providing a very detailed buy-side perspective. Finally, I'll now hand over to Rahul Patel to talk about the importance of technology in the context of managing.
So, as you know, managing liquidity is an ongoing challenge for many firms. Came across on risk.net, where a buy-side risk manager poll that took place at risk that they had little faith in their own percent of the delegates, mostly from the risk management desk, said that they had formalized measures of liquidity, and a staggering 85% said they needed better liquidity risk metrics. So it's quite clear and evident from this that this is an issue amongst many buy-side firms. So the regulators, as we know, putting extreme pressure on firms to deploy strong liquidity risk management practices. And when the global financial markets finding themselves challenged, it's crucial firms have the right tools available that allow for better decision making. This is why it's important for firms to have contingency plan in place. So many firms are looking to adopt a more holistic view to liquidity risk management, which is why firms are increasingly relying on new technology, such as the likes of Quantifi, that can seamlessly implement tools required to efficiently and effectively manage liquidity risk. So some of the examples, the ability to forecast cash flows over a specified time series to capture any shortfalls, applying stress scenarios to ensure liquidity is available under the stressed market conditions, and the ability to calculate time to liquidate your portfolio, all which can be viewed across various asset classes with a robust reporting engine to produce accurate analysis and to ensure sensible strategic decisions can be made. So without having the right tools, firms would have difficulty putting in place some kind of contingency plan. So let's discuss some of the tools required to help assist us with that. So a must-have tool that we see, clients demanding is a simple, just to be able to calculate what the availability liquidity is. Firms want the ability to see what their availability liquidity will be over a time horizon, which consists of cash holdings, and this can include cash that it would generate if a portion of the portfolio was to be liquidated, or settle cash, or cash from coupons from a given asset class, and other cash commitments such as used to cover your debt, margin calls, any tax commitments too. So firms are also expecting the minimum liquidity to be calculated with respect to the product class under stress conditions. So typically you want one would want to have the ability to define a percentage of assets that can be sold down in each time bucket by looking up our hierarchy of liquid assets across time horizon to help manage this, or simply being able to capture what your margin call is expected, and as a result adjust your minimum liquidity posting to reflect this. So it's important really, the portfolio manager or the risk manager has time to plan forward what the most cost-effective methods are to cover any shortfall or preempt anything, in the future. So based on that, one of the key things is being able to define rules based on historical behavior or some level of market behavior with the help of storing key information such as traded volumes, bid offer prices, redemptions. So this will help investment firms gauge with some degree of accuracy what their availability liquidity is to ensure that minimum liquidity requirement can be achieved. So something that Quantifi do, we provide clients, the ability to apply stress test scenarios under extreme market volatility. So whereby one can set a predefined measure for the EMV based on a particular asset class. Given the outcome of the result, the investment firm may want to rebalance the portfolio to align investments with the firm's target asset allocation to ensure the portfolio remains diversified by maximizing returns and also, key thing, minimizing risk. Or strategically tilt the fund's asset class and currency exposure based on long-term valuations, for example, buying cheap assets, selling expensive assets. And you probably also want to be able to, set a max tilt for a given instrument in order to find other means of readjusting your exposure too. And finally, if the available liquidity doesn't meet the minimum liquidity requirement calculated, a portion of the portfolio would be equitized. So say an equity stock position in favor for a futures or an ETF to raise cash. However, associated with that would be a margin call. So one would expect your minimum liquidity requirement to reflect this in the calculation. So whilst it's great to have sophisticated tools available to carry out a number of computations, it doesn't add much value if you cannot output the results in a manner that can be made of use. So having a flexible reporting tool is key. For example, as you can see, monitoring all cash flows across a defined period, and also giving the user the ability to set their required period that they wish to project the cash flows by simply defining the period within the calculator and rerunning your report. We find clients often organize trades using a variety of different groupings, and these groupings are often organized into hierarchies. The benefit is to use these groupings for reporting and analysis. So typically, grouping may vary amongst different firms. Some may set their hierarchies based on legal status, internal structure, typically even an asset class. So the ability for firms to drill down into various hierarchies provides a greater degree of business intelligence, which allows firms really just to make more, like we've seen in this. So one of the things I want to point out, and why it's so important to have the flexible reporting tool, is we believe single enterprise solution adds value. As some of us know, there are a number of key reportable fields under MiFID II mandate. It's very difficult to extract all the data easily. So one other consequence of using old technology is inadequate data integration. Applications can be time-consuming and costly. So we believe, and it's proven, working with new technology, where one may want to add abbreviation flag to determine whether an asset is liquid or not, is the level of functionality associated with modern risk technology solutions. Technology that is transforming how firms adapt to regulatory requirements and the related challenges being driven from the regulators, and with the political unrest causing uncertainty in the out of the box, how they can more efficiently and effectively adapt and respond to these demands. So investing in new technology adapt to change, reduce cost and increase speed of performance, all of which can help drive business, transform complex challenges. Yeah, that's all me done. So thanks for your time, and hope you guys found this of interest.
Great, thank you, Rahul, for outlining the importance. We'll now move on to the Q&A session, and we're seeing a few questions appearing in the panel. So the first one, what would you say is the main cause of liquidity change in the marketplace? Antonello, I'm wondering, maybe that's one that you could answer.
Okay, yes, it's. I mentioned a few when I was speaking before, but so there have been secular reasons as well as changes in regulations, and in particular, with the impact of the financial crisis, we have been experiencing incredibly low level of yields, and this has actually resulted in a change in the behavior of investors. So the appetite for liquidity the appetite for assets which have a lower liquidity profile has increased, has become more mainstream. At the same time, changes in regulations have caused a difference in the way the markets behave. On the fixed income side in particular, the market used to rely on broker-dealers' ability to intermediate fixed income trades. And in order to do this, they used to manage an inventory of securities. Now, the balance sheets have become much more expensive to maintain, and the appetite to behave in such a degree has actually changed. So the expectation is that the fixed income market may end up becoming more similar to what we experience as the equity market, so a more agency type of model where brokers simply intermediate transactions on behalf of end investors. I think the problem is that this is an expectation, but this isn't happening. So maybe this isn't happening quickly. There are a lot of changes which are also driven by regulations, in particular MiFID II, so aimed at increasing the visibility of transactions, the visibility of the flows being traded, the visibility of traded prices. So I would say there has been a combination of the aftermath of the changes due to the events of 2008 and the way regulators have reacted, regulators and monetary authorities have reacted. So this is, when I say secular, I mean these are not, I don't think these are changes which are temporary. This is something which appears to be generating a massive change, a massive difference in the way the market used to behave. And there's finally another consequence of the reduction in interest rates and the increase in the appetite for investors to own yielding securities has been an incredible increase in the issuance of debt. So actually the debt has become higher and higher. The size of issuance has become much higher, and this is actually combined with the reduction in secondary market turnover is resulting in much thinner markets, and this may be the precursor of liquidity shocks. So this is my take on it.
Great, thank you, Antonello. Another question we have is, will exchange-traded derivatives ever gain enough liquidity to match the current liquidity in the OTC markets, for example, rates? So maybe is that one you could have a go?
Sure, Sash, we're happy to answer that one. So when we look at that market, the exchange-traded versus the OTC market, we have to really know the origins and the fundamentals behind that to understand what the future could entail. So when exchange-traded derivatives first came for various different asset classes to gain various different exposures, these were new products, and these were new products in the backdrop of a very rich and robust marketplace, the OTC suite. So when they first start out, these exchange-traded derivatives, wherever they are and whatever product we're referring to, they're new, and they have lack of industry-wide participation, and the industry looks at these products as possible good solutions, good alternatives, lower cost alternatives than their existing means of trading. However, the liquidity is just not there for them to be confident enough to start to use the product. So it takes like a big bang type event for each product, for a certain threshold to be crossed where industry participants feel that this product is adequately liquid and liquid enough for them to change their existing behavior. It's very difficult for end users to change their existing behavior. Just because there's a better mousetrap or a better way to gain a certain type of exposure, it doesn't necessarily mean that the end users will migrate whole stop to that new way of doing it. people are used to, and financial market participants are used to doing a trade the way that they did it yesterday, if that trade was, relatively successful. So they'll continue to prefer their existing behavior instead of looking at new, maybe more cost-effective alternatives. So it's going to take a generational change. So all the more experienced participants in the marketplace, for all of those guys and girls to either completely change their behavior or exit the marketplace for the dominance of the OTC market to be affected at all. Once we do have a generational shift and a new presence in the financial markets that's mainly driven underneath and since these regulatory regimes, and that is the only way that we're going to have a wholesale replacement for the exposures that we're getting in the OTC markets. So the products have been relatively successful. The functionality, features, and easiness of use of these products are exceptional. The liquidity is still gathering in certain pools to support these products, and it's just going to take more behavioral changes for these products to ever potentially surpass the OTC suite. But when we do have that generational shift, I do predict that these products will surpass the OTC suite, but we're talking many, many years from now. Thank you, Sashvir.
Great, thanks all. Time for a couple more questions. So we have another one here. So what additional technology solutions could benefit you in handling liquidity conditions and managing the quality of risk? I think, Rahul, that would be a good one for you.
Yes. Not sure about additional technology, but I quite believe in the single enterprise solution. I believe it reduces the complexity of dealing with a number of applications, and I guess also having an open modular framework gives you the flexibility to adopt various features, allowing firms to handle various aspects that surround liquidity risk management without compensating with the level of quality of data. So, and around that, some of the other key benefits of incorporating a single solution, it keeps overall costs down, you reduce, as already mentioned, complexity, and you also reduce the risk associated with multiple integrations, because obviously you're not dependent on other applications, in the event that they may fail. So I hope that answered the question.
Great. So last question. So there's one here on regulation. So the question is, how has regulatory requirements put pressure on how funds manage their liquidity, internal model versus regs? Antonello, is that one you could answer?
Yeah, obviously you could have a very, very extensive answer, but there is a lot of focus by regulators on liquidity. So before I mentioned this has become a lot more explicit. I can see how my own behavior has changed. Liquidity risk management has been integrated in the day-to-day process, but obviously there are also very explicit requirements. Liquidity stress tests have to be carried out and reported, so they have to be defined. So in a way, the way regulations have been working has been, first of all, explicitly, because there has been requirements to identify, quantify, and report the liquidity profiles. The tiering approach I described previously is now being not exactly in the same terms, but it seems to be proposed by major regulators as a way to identify the liquidity of portfolios. And I think there is actually a more and more explicit discussion within the regulatory community in terms of taking into very explicit consideration the liquidity of investment strategies, something which may actually be, may be beneficial. Let's say that regulations at the end of the day have always the purpose of being beneficial and being in favor of better fairness and investors' protection is probably an increased focus in the risk of asset liability matching, asset liability consistency. I remember discussions about certain funds investing in real assets, real estate assets, and offering a liquidity profile which one may not associate with those type of assets. I think is healthy to have a discussion whereby one understands exactly the type of liquidity profile which is being offered and how realistically this is going to pan out in such strategies. So I think there is now a lot more, a much more explicit understanding of which liquidity terms one should offer on various strategies, and when describing those, there are sometimes extraordinary liquidity provisions being defined on certain funds. I think there is a more explicit understanding of how this provision should be and how realistic this should be, because I think I remember in the past these provisions being considered something which should never really be invoked, where nowadays I think one has to take into consideration that every now and again gates, redemption in kind, actually may end up being used. So this is summarizing, is not only explicitly with regulations requiring liquidity quantification, stress tests and reports, but also with a permanent change in behavior by financial actors. Okay, this is
great.
it.
Thank you, Antonello. I'm afraid that's all we have time for today. We've received several of the questions and we're aiming to respond to those via email. Please note we have a related white paper available on our website. You can go to www.quantifisolutions.com, and we'll also be posting a recording of the webinar in the coming days. Finally, the short liquidity survey that I mentioned earlier on will launch straight after this webinar. If you can spare a couple of minutes to complete that question, that would be much appreciated. And I'd just like to thank Rahul, Sol and Antonello for presenting today's webinar, and thank you all for listening. I hope you enjoyed the webinar. Goodbye.